Come on over, come on over, come on over. I want to talk to you today about IRS Form 1065 line by line audit triggers. There are 10 areas the IRS is probing this year, and I want to just kind of share those areas with you. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How are you today? I hope you are doing fantastic. I'm doing marvelous, if you were to ask me. If you are doing as terrific as I am, go grab a cup of coffee or tea or vodka and let's roll. In today's conversation, I want to have a serious discussion about IRS Form 1065 line by line audit triggers. What are the 10 key areas the IRS is investigating, is scrutinizing this year? First of all, let's talk about the types of IRS audits. When everybody talks about IRS audits, what are we talking about? You have two types. You have a correspondence audit, and then you have a field audit. So a correspondence audit is when the taxpayer receives a written notice about the tax return issues. So the taxpayer is required to respond in writing. So if you file Form 1065 and you receive a correspondence audit, you need to actually reply. This is the least severe type of audit. An office audit is when the taxpayer receives a letter to invite him or her to meet with the agent at a local IRS office. Usually, the IRS agent wraps everything up in one day with the office audits. So actually, there are three types of audits. So you have the office audits, you have the correspondence audits, and then you have the more serious one, the field audit. This is when the taxpayer is required to meet with the examiner face to face at the taxpayer's place of business, the taxpayer's home, or at a local IRS office to review the taxpayer's financial records and tax return. And the taxpayer can request to have the audit done at the CPA's office. And this is considered a more severe type of audit because the IRS wants to examine other issues. So if you want to avoid tax audits after filing the Form 1065 for your partnership, it's very important to not mix personal and business deductions. Make sure that payments to partners must be capitalized, deducted, or distributed correctly. Ensure that guaranteed payments are accounted for and not expensed. Generally, if the partner works exclusively or primarily for the partnership, payments are more likely to be treated as guaranteed payments per Internal Revenue Code Section 704C. Guaranteed payments cannot be expensed. Very important, folks. Do not treat a partner as an employee. And keep track of services and hours performed related to rental real estate. And ensure that the partnership agreement shows the allocation of income or losses to family members properly. Also, it should include the reasonable compensation amounts for those providing services to the partnership. And last but not the least, if you want to avoid tax audits, make sure that you understand that generally partners do not recognize gain or loss when they receive distributions from a partnership unless it is cash in excess of basis. Although the general rule aims to treat partnership distributions as non-taxable events, it is possible for a partner to recognize gain when he or she receives cash distributions with a zero basis. So, what are the top 10 areas the IRS is probing this year? Number one, other income or loss. And if you're claiming anything about other income or loss, you need to attach a statement to Form 1065. In other words, business income can include income not derived from sales or services. You need to substantiate it. You need to actually explain to the IRS what that is. And here I'm talking about property sales and casualty losses, rental income, investment income, recapture depreciation. You need to report royalties, recovery of previously claimed deductions. In some cases, maybe income. Most damage awards are income. Cancellation of debts may be taxable income. It depends on the transaction, and custom item deductible. And one important question to ask is, if you had paid the canceled amount, would the payment not just the interest here, have been deductible? If so, then the canceled debt should not be reported as income. And if you have also a reduction in cost of item, this could be considered a taxable event. Bankruptcy or insolvency, another exception applies to debts that are canceled in a bankruptcy or because you are insolvent. Generally, such debt forgiveness is not recognized as income to you, perhaps out of recognition that if you can't pay your debt, the government is unlikely to be able to collect any additional taxes from you. All right. And you also have qualified real estate business debts. There is also an exception here for forgiveness of qualified real estate business debts, but this gets into rather complicated territory, and I don't have time to cover that today. So remember that not all income is taxable. There are a number of items that you might think of as business income, but which are not considered taxable income by the IRS. So some of the major exclusions from income are contributions to capital. For example, if you deposit personal funds in your business checking account to cover a temporary cash flow problems, this is not income. It's equity equity infusion, if you will. Proceeds from loans, that's not income. Gifts, cash discounts for a prompt payment of bills, trade discounts you receive from suppliers, insurance reimbursements up to the amount of your loss, improvements made by tenants to property they rent from you, and like-kind exchanges. So I just give you a list, a constellation of all the items that may qualify as other income or loss. Either way, you need to substantiate, you need to attach a statement to Form 1065 when you put those on the form. Otherwise, you might get audited. Number 2, partnership income loss reconciliation to partners K1s. This is very important to understand that and I'm showing you right now on the screen, Form 1065 here. The IRS reconciles total partnership income to all income indicated on the K1s of all partners included on Form 1065. The agency then requests and reviews the partnership agreement to make sure the numbers are correct. So it's very important. There are two things happening here. So when you send K1s to your partners, the IRS does two things. First, it adds up all the income from all the K1s received. And number two, it actually compares and contrasts whatever was reported on the Schedule K1 to what you have in your partnership agreement. It's very important for a partnership to have an agreement, to have a partnership agreement, and it has to be written. I'm not talking about we all agreed, we agreed verbally. No, it has to be written down. And so it is so important because there have been cases where IRS auditors have asked to see the partnership agreement of the auditee of the companies being audited. So what to include in your partnership agreement? You need to have, if you don't have it yet, you need to have it ASAP, and you need to include a few things in the partnership agreement, namely the name of the partnership, the contributions to the partnership, the allocation of profits, losses, and draws, the partnership decision making, management duties, the conditions under which you admit new partners, the withdrawal or death of a partner, and resolving disputes. In other words, if you and your partners become, say, deadlocked on an issue, do you want to go straight to court? It might benefit everyone involved if your partnership agreement provides for alternative dispute resolution, such as mediation or arbitration. So the bottom line here is that your company is less likely to be audited if you have a proper partnership agreement in place, and that partnership agreement is in sync with the income you report every year, not only on your Form 1065, but also on the different K1s that you distribute to the partnerships partners. We have number 3, audit trigger number 3, sale of business property. This is very important, folks. And what is it? Basically, if you sell, and I'm showing you right now, this is basically on Form 1065 here. You can see it, and you need to actually file another form called 4797. This is where you report the sale or exchange of property, the involuntary conversion of property and capital assets, the disposition of non-capital assets, the disposition of capital assets not reported on Schedule D, the gain or loss for partners and S corporation shareholders for certain Section 179 property distribution by partnerships and S corporation, and the computation of recapture amounts under Section 179. We have covered Section 179 on another show. So I'm showing you right now the form 4797. And you can see the link on the IRS websites. So this is the form where you have to actually compute everything and then transfer the data onto onto Form 1065. So I'm showing you part 1 of the Form 4797. And then I'm showing you part 2, ordinary gains and losses, followed by part 3, gain from disposition of property under sections 1245, 1250, 1252, 1254, and 1255. So that's for number 3, the sale of business property. Very important to get that section right, otherwise you might invite an audit. Number 4, audit trigger number 4, guaranteed payments to partners. And I'm showing you right now, and this is line 10 on Form 1065, as you can see on the screen. Guaranteed payments to partners. And the guaranteed payments to partners are outlined in Section 707C of the IRC, the Internal Revenue Code. And this basically defines such payments as those made by a partnership to an individual partner for services or for providing capital, and which are determined without regard to the income of the partnership. And when such payments meet this definition, they are considered made to a non-partner for tax purposes for both the partnership, the payer, and the recipient, the payee. And more relevantly, such a payment to a partner is treated as ordinary income. This is very important. And for the partnership, folks, please check this out. For the partnership, such payment is deductible under RSC Section 162, ordinary or necessary business expenses, or capitalized under IRC Section 263. So you can either capitalize the payments or expense it. I'll be right back right after this. Don't go anywhere. Or before I actually go, I wanted to quickly show you that if you want to get more info about the guaranteed payments to partners, we have done some research, and we're showing you right now on the screen an excellent article by the CPA Journal that discusses all the important topics. And you can see this on the screen right now, along with a link to that article. But it's excellent, and this is an article in the CPA Journal. All right, I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another section of the Awesome Sweetie Kiwi Show. We're also having a conversation today about IRS Form 1065 line by line audit triggers. 10 areas the IRS is probing this year. Number 5, bad debt. So, if bad debt is line 12 on Form 1065, and basically bad debt really has an important element, and the IRS is really paying attention. Why? Because of the COVID-19 and the resulting economic crisis, hundreds of small businesses have had to file for bankruptcy, a situation that created a huge amount of bad debt in the economy, because people aren't paying people, right? So the IRS is paying attention to what companies are writing off as bad debt this year and next year also. So I'm showing you right now. For more info, you want to go on the IRS website, and this is we have the link here on the screen, and this is topic number 453, bad debt deduction. It talks about everything you need to understand. Now, one thing I want to say here is that generally, to deduct a bad debt, you must have previously included the amount in your income or loaned out your cash. If you are a cash method taxpayer, and most individuals are, you generally can't take a bad debt deduction for unpaid salaries, wages, rents, fees, interest, dividends, and similar items. For a bad debt, you must show that at the time of the transaction, you intended to make a loan and not a gift. And if you lend money to a relative or a friend with the understanding the relative or friend may not repay it, you must consider it as a gift and not as a loan, and you may not deduct it as bad debt. All right. Generally, there are 2 kinds of bad debts. You have business and non-business. And business bad debts are losses from the worthlessness of a debt that was either created or acquired in a trade or business or closely related to your trade or business when it became partly to totally worthless. And a debt is closely related to your trade or business if your primary motive for incurring the debt is business related. So you can deduct it on Schedule C, Form 1040, profit or loss from business. That's for sole proprietorship, or on your applicable business income tax return, in this case 1065. All right, so the following, and we're going to show this on the screen, the following are examples of business bad debts if previously included in income. And you can actually report those on your Form 1065. So loans to clients, suppliers, distributors, and employees, credit sales to customers, or business loan guarantees. And a business on Form 1065 deducts its bad debt in full or in part from gross income when figuring its taxable income. All right. And then we also have non-business bad debt, and all other bad debt are non-business. So those must be totally worthless to be deductible. You cannot deduct a partially worthless non-business bad debt. Very important. Number 6, folks. Number 6, we have depreciation and amortization. And this is, I'm showing you right now. Again, this is a line-by-line audit trigger review here. So we have here, I'm showing you on the screen right now, Form 1065. And depreciation and amortization, that's line 20. And here you have to use Form 4562 to claim your deduction for depreciation and amortization. You make the election under Section 179 to expense certain property, and you need to provide information on the business investment use of automobiles and other listed property. And we're showing you right now on the screen Form 4562. You can see you have Part 1, Part 2, and then you have Part 3 here on the screen also. You have Maker's depreciation. Maker stands for a modified accelerated cost recovery system. Then you have Part 4, and then on Part 5 you have to list the property, whether it is aircraft, automobile, and property used for entertainment, recreation, or amusement. And then we have the next screenshot. We have Section B, information use of vehicles. And then in Part 6 we have amortization. One thing I want to say very clearly here is that you cannot depreciate land. And the thing here is that when we talk about depreciation and amortization, you have to make sure that, except as noted, you need to complete and file Form 4562 if you're claiming property, if you're claiming depreciation for property placed in service in 2020. You're claiming Section 179 expense deduction, depreciation on any vehicle or other listed property, a deduction for any vehicle reported on a form other than Schedule C, any depreciation on a corporate income tax return other than Form 1120S, and amortization of cost that begins during the 2020 tax year. It's very important to explain that depreciation is actually the annual deduction that allows you to recover the cost or other basis of your business or investment property over a certain number of years. That's what accountants call useful life. And depreciation starts when you first use the property in your business or for the production of income. It ends when you either take the property out of service, deduct all of your depreciable cost or basis, or no longer use the property in your business or for the production of income. And you actually depreciate physical items, tangible items, and you amortize intangible items such as patents, goodwill, and so on and so forth. One thing I want to talk about here is we have number 8. Yes, we're number 8. No, number 7, folks. Number 7. My fault. Number 7. We have employee benefits. Now, employee benefits are very important also when you file Form 1065. And employee benefits here is, you see this on line 24. And you have fringe benefits. You have unemployment insurance, and you have workers' compensation. And you have health plans. Those are the 4th elements that the IRS tends to audit when it goes over Form 1065s. So fringe benefits are generally included in an employee's gross income, and unemployment insurance. So you have FUTA. So you have the Federal Unemployment Tax Act, with state unemployment systems provides for payments of the unemployment compensation to workers who have lost their jobs. And most employers pay both a federal and state unemployment tax, and only the employer pays FUTA tax. It is not withheld from the employee's wages. And you have workers' compensation, of course, and the health plans. So those, again, you got to have the proper paperwork. If you claim those expenses on your Form 1065, you as a business owner must have the proper documentation to actually avert or face any audit, whether it is correspondence audit, field audit, or office audit. You can actually face it with no problem. Then we have number 8, information on partners owning 50% or more of the partnership. In other words, partners who are majority equity holders. And this is on Schedule B. Schedule B of Form 1065. We're showing this to you right now on the screen. And this is where you have to, and I'm showing this to you along with a link to that particular page. And so here, what you have to do, you basically have to provide information. And the IRS tends again to scrutinize this area very importantly, because we're talking about the decision makers. We're talking about those who own the partnership, those who have majority say in the partnership. So this is something very important. I'm showing you the next form. So Schedule B1. This is where you put the name of the partner. Remember, the partner can be an individual, a person, or an entity. All right, so you could put the partner or the partner's social security number, or the entity's TIN, tax identification number. That's part 1, Schedule B1. And then you have a part 2 of Schedule B1. This is individuals or estates owning 50% or more of the partnership. Number 9. Audit trigger number 9, we have interest due under the look back method, and this is for a completed long-term contract. And for this, if you have to file this, if you ever, and this is, if you ever mention this on Form 1065, you really need to attach Form 8697 to your Form 1065, and it's very important. Now, your Form 8697 talks about interest computation under the look-back method for completed long-term contracts. Now, we have an entire show on this, so I'm not going to go too much into details here. If you need more help, you can talk to your accountant or a CPA or an EA to kind of help you here. The bottom line here is what? The bottom line here is that the look-back rule, the calculation, is basically, it takes a look at additional interest that needs to be paid to the IRS or refunded by the IRS on taxes paid on contract revenue that has been recognized in prior years using the percentage of completion method. And this is very important because, again, it is a complex process. So the IRS knows that taxpayers are known to make mistakes here. So the government pays attention a lot. And one thing I want to say here before going to number 10 is that the look back rule was created actually to understand the fact that there is a temporary difference, because since contract revenue reported on the percentage of completion method is based on estimates, a taxpayer could defer reporting taxable income in 1 year by understating a contract's percentage of completion. So essentially, taxpayers could push off reporting a majority of income to the final years of the contract. So for a large and or long contract, that could mean big dollars and a long wait for the IRS. And the IRS doesn't want that, right? So yeah. And audit trigger number 10, we have to reconcile taxable income with accounting income. And so I'm showing you right now on Form 1065. This is how it looks on Form 1065. And then you have how it looks on the actual Schedules M1 and M2. You see that on the screen right now. So basically here, the simple thing you have to remember is that accounting rules, accounting standards, accounting principles are different from IRS principles. Because of that, you have temporary differences. And those temporary differences create what accountants call deferred tax assets and deferred tax liabilities. This two schedules are just used to reconcile those temporary differences. So nothing of really complicated here. And if you use accounting software to prepare your Form 1065, the software will do it automatically for you as long as you input the right data. All right, folks, this was it for today's conversation. I was just talking to you about IRS Form 1065 line by line audit triggers, and I was just talking to you about 10 key areas the IRS is focusing on these days. Number 1, we have other income or loss. Number 2, we have partnership income or loss, reconciliation to partners K1s. Number 3, sale of business property. Number 4, guaranteed payments to partners. Number 5, bad debts. Number 6, depreciation and amortization. Number 7, employee benefits. Number 8, information on partners owning 50% or more of the partnership. Number 9, interest due under the look-back method. And number 10, we have reconciliation of taxable income with accounting income. Thank you so much for your attention. I really appreciate it. I will see you next time. But until then, remember, stay marvelous.